Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Sunday for Sunday, October 3rd, 2021. We've got another great show for you this week. I'll be joined by members of the media, academia, and financial services as we analyze all the news that took place during the week. So sit back, relax, enjoy this episode of BRN Sunday. Let's kick off the show with a look at what's going on in Washington, D.C. a lot these days. And joining us to break it all down, they're known as the Legal Eagles, but they're also known as David Levine, Kevin Walsh. Both are principals with the Groom Law Group, an employee benefits law firm based in Washington, D.C. Gentlemen, great to talk to you as always. Thanks so much for joining us this morning.
Jeff, it's always good being on the program. And, I think this week, the Eagles, when we talk about undisclosed locations, we're talking about privacy. So I think this week we're going to talk a little about the intersection of privacy and benefits.
All right, David, take us through. Thank you, Kevin. David, take us through.
Well, privacy always begins on a good note, Jeff, because if any of the listeners heard today, you said Washington. So that is a tip-off that your home address might have come out of, I don't know, Baltimore, theoretically. Yeah. Am I wrong or am I right?
I think you narrowed it down to at least one of the 50 states and one major top 20 city, yeah.
Okay, so you're from Springfield, like Homer Simpson. We got it. And that was a good one.
Thank you.
And the reason why we're saying that today is because privacy, we know we've got all the legislation out there, and as each week goes by, nothing has moved as of the time of this recording, so that's why we're not talking about it. But privacy continues to be a discussion topic. You see it in litigation, you see it everywhere. But this week, we're going to talk a little bit about what's new in the world. First, there is increasing pressure, separate and distinct from reconciliation, to have some type of privacy legislation at the federal level. The problem is there's still a pretty wide gulf at this point, because things like private right of action, should people have it or should there not be? Also, can states have more rigorous requirements, and if you can put rigorous in quotes depending on who you ask, about privacy than the federal government? These are things that are dividing, not perfectly, the Democrat and Republican camps, and these are things that will take some time. But while the legislators take their time to figure out if they can get to compromise, given we have a lot bigger compromises we're trying to reach, it's important to remember that the regulators are not asleep at the switch either. The regulators, especially the DOL, continue to focus on privacy. Most recently, we had two exemptions, and we can make this really wonky, but to translate this to simple English, sometimes in ERISA...
Oh, make it wonky, David. Make it wonky. People want wonky.
Yeah, makes you sound really smart.
For the A block, Kevin, that's definitely not what I think Mr. Snyder wants.
The A block's the wonk block.
Yeah, that is the wonk block. Give us wonky, and then someone can break it down. I like wonky.
Okay. Under ERISA is a backwards law. Under ERISA, almost everything that you could want to do is prohibited unless there's a specific allowance to do it. In other words, you don't ask forgiveness. You got to make sure it's allowed before you do it. These are so-called prohibited transactions. And one of the things that people do is on their healthcare plans, they will oftentimes say, look, we're going to actually have our own insurance company and we're going to insure our own risk. Why do you do that? There's a bunch of reasons, much longer segment, but it's good business and can work out well for the cost of benefits. And because if you're an employer and you're insuring yourself, that looks like you're funneling money to yourself for insurance. And that leads you to need to go get, in a lot of cases, an exemption from the sort of self-dealing rules of ERISA, the prohibited transaction rules. Anyway, as part of that process, the DOL, the Employee Benefit Security Administration, puts out proposed exemptions. They put out two a couple weeks ago. The exact taxpayer is not relevant. But the key about this is that they said in these exemptions, the company, in very broad language, will not use the data for any purpose that benefits itself. That's a simplified version. But why do we care? Because it's the Department of Labor, through a formal, basically guidance process. And yes, it's just for this specific taxpayer or employer, but in a formal process, they're saying, here are some hard and fast and tight rules on the use of data. And that means, even though it's just in like healthcare right now, and just in healthcare is probably in quotes because healthcare is huge. This is something else that the DOL, like they've done on many other areas, could then turn around and say, see, we take tight rules on the use of data. They also did this in the Retirement Clearinghouse auto portability exemption guidance. The point is, we're getting more and more sort of groundwork, foundational work from the Department of Labor that's saying, look, there are extremely tight uses of data in benefit plans. Given we spend so much time in our industry talking about wellness and using information to benefit participants, we can debate the pros and cons all day long, but the simple answer is the DOL is moving ahead, regardless of whether we have legislation or formal wide-ranging rules. Kevin, you want to chime in?
Yeah, David, do you mind if I chime in a little bit here? I think the first key point here, and I don't want it to be lost on listeners, is that when the department does things like individual exemptions, they go through notice and comment. So right now they've put these out as proposals. There's still an opportunity to try to get them changed. Now with individual exemptions, they rarely get many comments, so it'll be interesting to see if folks are keyed in on this issue and suggest that an employer has to be able to use the information to figure out if their program's effective. The other real big kind of front on benefits this week is in the second infrastructure package. There's $1 billion for the Federal Trade Commission, which is designed to give them, funds to, go and develop a privacy enforcement arm for the next 10 years. And again, what's kind of frustrating with it is it seems as though Congress is recognizing that there's disagreement over how privacy should be regulated. And so they're having trouble putting together a statute. And in a way, it looks like they're trying to punt to a regulator. So it's going to be interesting to see where that goes and if that develops. If it passes, the FTC is going to be another player to watch in addition to the Department of Labor and the states.
Hey, Kevin, I thought we said no legislation this week.
I thought we were saying privacy this week. I thought, I don't want to shortchange our listeners by just talking about, wonky little exemptions when there's action going on the Hill on the same front.
Yeah, let's see if it passes. We can debate this all day long. Jeff, break us up.
Yeah, look, this is good stuff, and I think where does this sit in the prioritization? I mean, obviously the priority right now on the Hill is this reconciliation bill, this infrastructure bill, whatever you want to call this thing. Whether it's $3.5 trillion, I think it's now close to $1 trillion, so I think it's come down. Right, that's the focus. But where does this come back up from a? Does this come up after that bill passes or doesn't pass or is blown up?
So Jeff, there's two bills right now on the Hill. There's the BIF, the bipartisan infrastructure bill, which has already passed the Senate, and the House progressives are threatening to not let pass until there's agreement on a larger reconciliation package. The second package is the reconciliation package, usually called Build Back Better. That package is the one that has the FTC money in it. So it's part of what's going on right now in DC. And as you suggested, there's that $1.2 trillion package that the House is sitting on, and then there's the framework that the progressives want decided before they'll pass the $1.2 trillion package. And right now it looks like that package will be somewhere between $1.5 trillion and $3.5 trillion if Bernie Sanders and Joe Manchin are going to reach an agreement.
And I mean, this is just the horse trading that goes on. But because of the slim majorities in both houses, this is why groups can put up roadblocks, right? I'm just trying to understand the political infrastructure, pun intended, of how this works. So, like, if you have a very slim majority in the House, 3 or 4 to 3 to 5 seats, you have basically the vice president breaks the tie in the Senate. That's why everyone's got to kind of work through all these details, and I guess we'll see more of this throughout the weekend where there's some horse trading going on, and you support my thing, and I put this in the bill and whatnot, right?
We'll definitely see more horse trading. At the moment, yeah, it seems like there's a by Speaker Pelosi. At the same time, it seems as though if the Senate doesn't come to the table, either the progressive wing or the centrists are going to have to back down, or there won't be a deal.
Yeah, it's going to be interesting to watch. I mean, I think it is kind of kabuki theater, and it's a shame that someone's always got to put their foot in the proverbial ground and shake things up. But I guess that's just the way things work. Gentlemen, we're going to leave it there. Really interesting. Really interested to learn more about privacy. obviously on this show, privacy very important, but also benefits, being able to get your benefits, and that intersection, that's a key point of equilibrium. Thanks so much for joining us. Have a great rest of your weekend, and we'll talk to you again very soon.
Thank you, Jeff.
Welcome back. Now time to talk a little tech and consumer products, and geez, we go all over the place. And joining me now to discuss this a lot more, Daniel Klein is lead advisor, executive producer for 7 Investing. Dan, always great talking with you. Thanks so much for joining us this morning.
Good morning, Jeff. How are you?
I'm doing well. Yourself?
I'm good. It's been beautiful here, but today it's depressingly rainy. So I don't know. Normally I get a little fresh air before taping, but that did not happen today because it is a little gray.
Well, I hope they get it out of the way for the rest of the weekend, but only I guess time will tell. Dan, a lot of individuals, we're not sure. Office returns staggering, meaning people are pushing back. We don't know. It's all different across the U.S. and across the world. But interesting story I know you brought to my attention was 20% of Americans polled, and again, who knows what the polling number was, would go freelance to stay remote.
I've actually been shocked by how often I've heard this, and shocked on a couple of levels. First, that companies care whether people come back to work. I'm surprised more companies haven't gone to hey, we want you to live so you can, come into meetings every now and then, and there'll be some level of office visits, but we don't really care if you're here every day. And some companies just aren't doing that. But I'm also surprised that people are willing to quit a job with benefits, with steady pay, because they have to go back to the office. Now, in some cases, is that, hey, you have to go back to the office full time and people just don't want to do that, or maybe they can't do that because of how their kids' schedules have changed. But I think a lot of people just like not commuting. And I get it. Like, I'm someone who I didn't commute, and then the pandemic started. And because my wife was home, because my son was home, I had to get an office. And I had 6 months where I did the opposite of what everyone else was doing. And I don't want to say I hated it, but I didn't particularly like it. It's a lot easier to, walk down a flight of stairs to record this with you than it is to get in my car, even though it was only a mile away. But I do think people are really understating the risk in becoming a freelancer. When you're an employee, you get guaranteed pay, you get hours, you get paid time off. There's just a lot of things that, if you become a freelancer, you don't get, even when right now, geez, it might seem like there's an endless amount of work. When things get tight, who gets cut? The freelancers get cut.
Yeah. So Dan, let's unpack this a bit. And right, some of it could be they don't want to commute. If you live in a big city or near a big city like New York, I mean, that isn't. It could be an hour and a half, 2 hours each way. You want to maybe save that. But I think you're right. There are a lot of things that you need to consider before taking this plunge. You mentioned the hours, you mentioned the benefits. What are some of the other things that you and I and others need to think about before we go down this route?
Yeah, I mean, career advancement. So if you're a freelancer, look, I was a freelance writer for many, many years, and I like to stick my nose in things. So I got involved in all sorts of other projects. But because I didn't work for the company I worked for as an employee, it was much more difficult, and people would get promoted above you, or someone would change, and all of a sudden no one remembers that you work on a project that you started. It's just more difficult as a freelancer at most companies. Now, does that mean there aren't perfect freelance situations? Of course not. There are some wonderful ones. I had a wonderful one for a very long time. But you are giving things up. And yeah, in some cases it means, wow, I can make as much money as I want. On the other hand, it means if you take a vacation, nobody is paying you. And things like health insurance are a factor. I mean, my wife, I'm very lucky, has a traditional job. So the fact that I'm a contractor, because 7 Investing is a very small team, the fact that I'm a contractor isn't as relevant because we have benefits through her. But if we didn't, it would absolutely impact my career decisions. And it's really easy to say, geez, I don't want to get in a car. I don't want to go to an office. I love this flexibility. But you know what's also awesome? Being able to go to the doctor when you're sick because you have health insurance.
Yeah, I mean, that is really important just to understand. underscore. I mean, you need to get your annual physicals. You need to do all those things. That is, if you don't have your health, you have nothing. But Dan, why don't we break it up into, or kind of section it into different groups of people. So if you're a little bit older worker and you have a lot of experience, this may be a good jumping off point to start your own consulting or freelance firm, right? That if you're a specialist in design work. And I think a lot of companies, there's still a lot of uncertainty out there in terms of reopening, the economic conditions. There's still a lot of job opportunities out there. So maybe people would be a little bit more flexible. And if you have that experience, maybe you can, and you have contacts, that leads to more business.
Yeah, absolutely. Look, there are entrepreneurial ways to do this. And maybe you want to start a little company. Maybe you want to just work with yourself. But you have to be the type of person who has that discipline. I mean, Jeff, when I worked as, primarily a freelance writer for 6 years, though I did other things, I had the discipline to be, I don't know, on a cruise ship in the middle of the Bahamas and get up at 5:30 in the morning when the internet worked so I could send out some emails that were something I got paid for. Or I might, finish a late night, get back to my room at 2 in the morning, and wake up at 7 because I had stories due on deadline, or because I got a news alert and there was something that was worth writing a story about. That takes a lot of discipline. If you decide to do that, and because you've done some consulting, if you have a client and that client needs you, they don't care that you're on vacation or about to go down a water slide or whatever it might be. So yes, there's an enormous amount of opportunity, but it's important that you go in eyes wide open, because when it's great, it's great. Like when it's a normal week and you're making a bunch of money and clients are paying on time and everything's going well. But then when something happens, and normally you just tell your boss, hey, I'm going to be a little late today. Well, there's no backup. There's no one who can do your work. And I'm not saying you can't grow your company and have other people but ultimately it's a lot of responsibility, and it isn't for everybody. Just because you don't have to get in a car and go to work. Now, what I would argue is a lot of people that have a job that don't want to go back to the office, the economy is really good. So if freelancing isn't right for you, well, the economy isn't necessarily great, but the job market is really good in most cases. Keep your job and then look for a job that doesn't care if you come into the office. Like, it's always easier to find a job when you have a job. And again, you can make a wonderful life freelancing. I've worked from beaches and islands and cruise ships and amusement parks, Starbucks, and wherever it is. But you have to know what you're getting into. And it is not all, pina coladas on the beach while you're answering an email.
Yeah, Dan, let's not forget about FICA. Paying Social Security, paying Medicare. You as a freelance.
I thought you were going for the Swedish coffee hour, but I guess that would be fika.
Fika, yeah. No, I'm not that cultured, Dan. I'm not that cultured. I drink black Starbucks coffee or whatever is available. But let's talk about that for a second, because there are things that you pay. So when you look at your benefits, and you got to do that, sides of a sheet of paper, or a tablet, and you say the pros and cons, and you look at, okay, you look at your pay stub and it says wages, benefit like a 401k, healthcare with the 401k match, FICA, FUTA, the Medicare, all that kind of stuff. There are things that you will have to pay for. So it may look greener with more money, but some of that money has to pay both sides of your Social Security, your Medicare, right?
Yeah, I mean, so most people who are freelancers pay quarterly taxes. And what they do is every quarter they pay estimated taxes. And as long as you're making a good faith estimate, at the end of the year, you don't pay a penalty. So if all of a sudden your income spikes or something's different, but you made a good faith estimate. But I do something different, Jeff, and I actually recommend this to new freelancers. I do it because I'm lazy. I don't want to have to figure out exactly those things and worry about the IRS and all the different things. I actually use a payroll company. So I set up a corporation. I use LegalZoom. It costs about $300. And I pay Florida unemployment and my Social Security tax and all of that. So I have money coming in, and because I work under contract, I have a base set amount every month, and I pay myself every 2 weeks or twice a month, actually, like you would at a regular job. And if there's an excess, yes, I owe taxes on that, but I also have expenses. So if my excess, if I know I'm going to be able to write that off amount because of my office rent or whatever, like buying a new computer or travel or whatever it might be. So I and that's not the most tax advantageous way, but for me, it's the least confrontational way. And I know a lot of other freelancers do that, especially if you end up getting needing something where you need a pay stub, which it won't help with a mortgage when you own the company, but a lot of different types of loans or renting an apartment or whatever ask for a pay stub. And I actually have a pay stub, which most freelancers don't have. Again, not the same as working for someone else when it comes to something like a mortgage. Mortgages can be very tricky for freelancers. And that's actually something to think about. If you're going to go freelance, getting approved for a mortgage is much more difficult. And generally, they're going to want to see 2 years of steady freelance income as reported on your taxes. There are ways around it. There are bank account loans, but it's generally going to require at least a couple of years of steady or growing income. So there are a lot of things you could do, but if you're going to go freelance, I highly recommend, if you don't go speak to an accountant, you at least read a whole bunch of articles from credible sources, like my old friends at the Ascent, which is a Motley Fool company, where they really cover, how do I do this? How do I handle my taxes? How do I handle paying myself? Because you can get into trouble really, really quickly. All that money coming in is not yours. That is really important to remember. The government still gets its share.
Yeah, and let's not forget, Dan, we're talking about it is advantageous today. There's a lot of work out there. People are looking for employees, but are also looking for support in some way, shape, or form. But the pendulum always swings back. And so if you don't have the discipline, and what, as a sole proprietor or the owner of a company, my job is not only to produce great shows, to do consulting, but also to find clients, right? To find prospects, to do my marketing. I mean, that is part of my DNA every day that I get up. I get up at 4 and I'm working all the way through till maybe 6 or 7 dealing with clients.
Yeah, and look, I was very lucky to be a single company freelancer for 6 years. That is very, very rare. Most of my friends who are freelance writers or freelance designers or whatever it is, they have a bunch of clients. And you might, for like 3 years, have a client that's like half your income. And then all of a sudden, whoever hired you leaves. And the next person decides, geez, you know what? I want an in-house person that costs less, that I can control more. Or I've got a buddy that does this, so I'm going to give you less work. One of the scary things when I was a freelancer working for all sorts of different clients was, you would get work from one company. The other thing is, you have to deal with getting paid. When I worked in the magazine industry, some very big magazines would, hey, it's a buck a word for this 5,000 word story. Well, that sounds great. But 120 days later, the check hasn't arrived. You'd call up to say, hey, where's my money? And then say, we'll send you that soon, but would you like another story? It can be a very tricky world, and you're everything. You are the rainmaker going out to get jobs. You're the person doing the work. You're also the accountant, the person sending the billing and making sure you get paid. So again, it can be a wonderful life. There's a lot of freedom to it, but it is not as good as it seems now. We are in a period where companies can't find full-time workers, or they're hesitant to pay because of the benefits and because of all the things, and they're more willing to use freelancers. But that pendulum tends to go in both directions. So recognize that the freelance life can be very, very up and down.
Yeah, really, really good point. I think a lot of people need to think about that before they leap off and do this. It can be very rewarding. And candidly, Dan, I spent a lot of time in front of my computer, so it's not as rosy, at least not for me. Dan Klein, always a pleasure chatting with you, my friend, and look forward to having you back on the program again very soon.
Jeff, I'll see you next week.
See you, buddy. Bye-bye. Welcome back. Now we're going to close the show, take a look at markets. Joining us on the line, he's the lead anchor for the TD Ameritrade Network. We're talking about Oliver Rennick. Oliver, thanks so much for joining us this morning and making some time.
No problem at all, Jeff. Thank you for the invite as always.
Absolutely. It's always great to talk to you, and you are really generous with your time with us. We appreciate that. Oliver, give us, over the last 7 days, a lot of volatility, interesting economic numbers, interesting market numbers. What's your take on all this? How do you break it down for your audience?
Well, the perspective number one is that we are on a pretty interesting kind of juncture here, technically looking at the market having pulled back from the all-time high that we charted the first day of September. So this past month was obviously not a great one as we peaked out the index that first week of September. So right now we're down about 5%, which is not a large amount magnitude-wise, but it definitely is catching a lot of attention because this has just been such an unstoppable rally. To see some weakness emerge as, of course, people doing a lot of soul searching, even though we're only 5% off the highs. But I think we should be soul searching, because some of the things that I've been warning about for several months, really, basically since kind of the end of Q1, my overall view has been quite cautious of the market due to the eventuality of the Fed turning directions in terms of policy, and then also the eventuality of COVID retreating further with each successive wave. And with that retreat also comes major rotational force within the stock market that can be powerful enough to derail the overall index. And it's actually precisely what we're seeing here. So when you look at the top of the market, the first week of September, that is also the exact time at which the reopening trades actually started to outperform tech and defensive style growth stocks. So that relationship between businesses that are really strictly dependent on the economy and reopening compared to the businesses that have been winning in this tech survival quarantine economy, when that relationship turned in favor of reopening trades, which happened at the last like 2 days of August. So there was about a 2-day spread between that rotation happening towards reopening trades and the stock market peaking. So this really exhibits why we're in such a pickle here, because the recovery and the hopefully eventual victory over COVID, and to some degree we're seeing that where we had a bunch of cases again, and it was a really bad period for Delta, but the deaths relative to cases remained muted compared to previous booms of COVID booms and surges because of vaccines, obviously. So point is, even though we're making a lot of progress on returning to normal, that shift is very difficult for the market to go through. So we're seeing now that the drag from tech companies is enough to outweigh the liftoff in some of these reopened trades. And the question from here is, are there going to be enough buyers of airlines, cruise lines, and cyclical businesses to keep the market going if tech is no longer leading? And so part of the answer to that question basically is no, there has not been. And we don't really know if that will change. So we just have to keep watching the price action.
Thanks for that, Oliver. Just a quick question for you. I know you mentioned the Fed, and the Fed looks like Jay Powell seems to be talking, although sometimes it's hard to decipher, that there may be some rate raise at some point in 2022. What do you make of, I think, two Fed governors retired or announced? I mean, is that
quite a scandal?
Well, I don't know if it's a scandal, but is it concerning to you? Is it when someone in your position, in the catbird seat, that you're watching all this stuff transpire? They could say it's for health reasons, or is it policy differences?
Well, it seems that they also, though, in the case of Rosengren and Kaplan, there is definitely some connections to the story about their investment positions. So that specifically, I think, is what really caught people's attention, as Kaplan's statement, acknowledged that there were criticisms about his trading that was made public. So, I mean, there's definitely some kind of conspiracy theorists that feel they may have been justified. There's always been this camp of folks in the market that believe the Fed is, just pumping and buying and stock, and then the Fed officials apparently, sell out of their stocks and the market starts peaking out. I mean, it's kind of an interesting story from a juicy sensationalist perspective, but the reality is it seems the Fed is pretty well anchored to that tapering timeline right now. There is a case to be made that Kaplan and Rosengren were slightly more on the hawkish camp. So does it turn the overall Fed dovish? It's possible. It is certainly possible.
Yeah, Oliver, what do you make of the what's going on in Washington, D.C.? How does that factor into your programming? I'm sorry?
It's a mess.
Yeah, it is a mess, but I mean, it has been a mess and will continue to be a mess. But what do you make of this infrastructure bill? It's this, you know, constant source of horse trading that's going on. Now I think it's smaller. I think it's $1 trillion. Then I think that we're talking about 3.5 trillion. But how do you take that information? That's policy. That's money that
Right.
could be injected. How do you take that and plug it into your programming, your model?
Well, it's hard to do it without any conclusion to it, but it's definitely been a very important factor for seeing some of this volatility emerge. The most important thing to understand right now is that we have a kind of liquidity trap of sorts approaching. That's maybe not the best word to use, but there is a squeeze that is happening on American consumers as the rate of new money coming into the economy peaked out in the first quarter. So the year-over-year change in money supply peaked in the first quarter after this incredible surge. So that definitely has an impact in terms of just the standard that we've gotten used to now and probably reflected in market valuations. So you have a slowdown in terms of support from the government with unemployment benefits that now have expired. And on the other end, there's nothing new coming in right now. So this impasse in Washington and failure to even have a single party agree on what they want to build or spend is certainly very negative for the market in general, especially after stimulus has been promised. So that's a tough kind of needle for the market to thread here, and I think is really a major source of potential downside, because if there is no shockingly big stimulus that has not already been priced in, then you've got trouble, because you are also dealing with inflation, which is tightening, and the Fed, which is tightening. So just the amount of money sloshing around the system, as people like to say, that has always been a bull case. I mean, the rate at which that money was increasing has definitely peaked. So, I mean, that rate of change, I think, is going to be important to the market. And it could be buoyed if there's some big stimulus deal that comes down the pipe, but it doesn't look like that's in the cards at the moment.
Last question, Oliver. Some new programming. TD Ameritrade Network has led the way in terms of OTT and covering markets, and you've been a big part of that. You've been anchoring 2 shows, but you guys are adding some new shows to the lineup. Do you want to say a few words briefly about what people might want to check out?
I'm sitting next to a couple of the new anchors, Jenny Horn and Alex Coffey, who have been on air, and Alex has been anchoring Fast Market for some time. They are going to be hosting a new show, Next Gen Investing, which will focus on some of the exciting kind of high volume, high activity trading names, meme stock stuff, and just trying to stay on the pulse of the very fast moving market. It's every other day, company is just surging. Yesterday we were talking about GoGo, the in-flight wireless service business that just kind of out of the blue just took off. So trying to keep track of volatility in those names. And then Nicole Pedalides, host of the Watch List, she'll be hosting a new show, Investing 360, which is going to be a cool spin on the macro plus the stock stuff. So I appreciate the shout out.
Thanks, it's going to be great. People certainly should check it out. Oliver Rennick, always a pleasure, and appreciate you making some time out of your busy day to join us. Have a great rest of your day. Have a great weekend. We'll talk to you again soon.
Same to you.
Thanks, buddy. Bye-bye.
All right, thanks, Jeff.
Bye. And that wraps up this episode of BRN Sunday. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow for BRN AM. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.